Chris, how are you? Are you ready to get started?
I'm ready to go when you are.
Alrighty. Well, thank you again for everybody for being here. And on behalf of the National Glass Association, I'm Sarah Neiswanger, Director of Membership, and I am joined by my colleague Katie Devlin, NGA's Chief Content Officer. And we thank you for joining us for today's webinar, where we're welcoming back Chris Beard of John Burns Research and Consulting. This year's Industry Pulse report further exemplifies the solutions-based mindset at which the fenestration industry is so adept. This is available at windowanddoor.com, and we'll put a link to the chat here in a moment. But key industry challenges that rose to the top include, probably not surprisingly, labor, rising costs, and the national housing shortage. So we will post that here shortly, and I hope you will take a few minutes sometime this week to browse what it has to say. And later this summer, NGA is introducing a brand new event for the glass fabricator audience. This is GFAB, the NGA Glass Fabricator Conference, which combines the strengths of NGA's previous events for this audience, being the NGA Glass Conference, the gathering of NGA's committees, and the venue for discussion of technical and advocacy topics, and GPAD, which was Glass Processing Automation Days. And this was a fabricator conference focused on all that they need to know about improving efficiency, productivity, quality control, and more related to the factory floor. So this inaugural event comes to Chicago, June 14th to the 16th. And we hope, if you're a glass fabricator, a supplier partner, an executive or decision maker in the glass industry, technical or engineering leader, or working on the plant production floor, such as a manager or in quality control or maintenance or tempering, this event is for you. Registration opens the end of this month on March 31st, and we hope you will check it out. I'm now pleased to introduce my colleague, Katie Devlin. Katie has been with the NGA for more than 20 years and heads up our magazine publications, being Window and Door and Glass Magazine, along with our conference programming. Katie?
Thanks so much, Sarah. I am delighted to be here today with Chris Beard. Chris's presentations are always some of our most well-attended webinars at the NGA. I know everyone is super eager to hear all of the insights and updates on market performance and trends in this sector. Window and Door and the NGA have been collaborating with Chris and the team over at John Burns Research and Consulting for, I think, about 3 years now. We've been working with them to produce the really essential and in-demand window and door market survey that's produced quarterly. Chris does just a tremendous job with this report, and we're grateful to have his collaboration on that. He's also a regular speaker here at Thirsty Thursday and at the NGA's Glass Build America, and his contributions frequently appear in Window and Door. Before I turn it over to Chris, I do want to highlight just a couple of big items coming out of Window and Door. The first is the top manufacturers report. This is an annual report that we've done at Window and Door for decades now. It's our comprehensive industry ranking and market report for North American manufacturers of residential products. The deadline for this is March 20th. I'm going to repeat that again because I think we've got a lot of you on this call. The deadline for submissions is March 20th. That's next Friday, so don't delay. We'll be posting a link to the survey submission page in the chat. And second, this week we opened up submissions for our annual Window and Door Awards. So don't hesitate to submit your standout innovations. The awards give just a really awesome opportunity to celebrate the work that you all are doing, the product innovations that you've been putting together throughout the year, the solutions for your customers' top demands. We've got recognitions for your window systems, doors, components, machinery, equipment, and more. I did want to call out 4 new categories this year. The first is our best residential case study. This is your chance, if you've got those finished project photos, show off. This is a great opportunity for us to bring some new folks in the broader residential design and build community into this awards program. Let's show off the windows and doors in their finished state in those projects. Also, a legacy leadership award. This industry is really built on people, and with this award, we're giving everybody the opportunity to nominate their legacy leaders at their company or folks that you've worked with for a long time. The winner of this award should be a residential industry veteran whose work or leadership or expertise has really helped shape the window and door fenestration industry. So tell us about those legacy leaders that you are lucky enough to interact with. We also have Best Digital Tool. We've been seeing just tremendous technological innovations at window and door companies. And finally, Best Training Program. So don't hesitate. The deadline for that is March 31st. If you have any questions about either of those programs, please contact Associate Editor Rachel Vitello. I've got her name there, but we'll be sure to post her email in the chat as well. And without further ado, I will hand it over to Chris.
All right. Thank you, Katie. Really appreciate it. It's great to be back with everybody. And so I've got a couple of topics that we're going to talk about today. First, we're going to talk about the macroeconomic backdrop. We talk about that every year. And it seems like every year we think like there couldn't be any more wild cards, but there seem to be a whole lot of wild cards. So we're going to talk about what we're seeing right now as we're now almost a quarter of the way through 2026. We'll talk about new construction, what that means for the fenestration industry, a little bit about repair and remodeling as well. And then finally, some insights from our latest window and door market survey, which highlighted the fourth quarter of 2025 and full year 2025 results. And then finally, we'll wrap it up with some takeaways, and we should have some time for some Q&A. So with that, I'll just kick it off with the macroeconomic backdrop. There's been a lot of talk about mortgage rates. We've been talking about mortgage rates really since the Fed started increasing rates several years ago, and we're expecting relatively stable rates. There's been a lot of talk in the industry about, when are rates going to come down and the Fed's cutting, and I think there's a lot of homeowner expectations that mortgage rates are going to fall with the Fed rate cuts. And obviously, we know that that's not always the case. That's more tied to the 10-year Treasury. But regardless, looking back to last year where interest rates were really well north of 6.5%, approaching 7%, we're at around 6% right now. And so we see, there's a headline a couple weeks ago from the Wall Street Journal that mortgage rates did fall below 6% for the first time since 2022. So that is positive. We're starting to see some improvement in rate cuts in mortgage interest rates. Looking forward, we're expecting relatively stable, still hovering around that 6%, just based on what the bond market is expecting for the 10-year Treasury. We're expecting the spread to remain kind of constant, really above what we'd seen historically before 2022. But there's some chatter because the president posted back in January that he's instructing his representatives from Fannie Mae, Freddie Mac to really increase their mortgage-backed securities. And so this is a history of the retained mortgage portfolio going all the way back to 2013, so coming out of the GFC. And we can see that the Fed throughout 2025 or Fannie Mae, Freddie Mac had already increased their purchase of mortgage-backed securities. And he said he's instructing representative to purchase an additional $200 billion in these mortgage bonds. And we did see that through 2025. That did accelerate following this announcement. And so when we look at the 10-year Treasury and the spread, if you will, between the 10-year Treasury and the prevailing mortgage rate, these mortgage spreads typically widen in recessions because there's a possibility of default risk. More consumers may be unable to pay for their mortgages. So that spread widens in a recessionary period. And then also in inflationary phases, just because of fixed interest payments are less valuable when inflation is running rampant. Neither is really the backdrop of today. So the spread between the 10-year Treasury and the 30-year fixed mortgage has been shrinking. The piece that we've been keeping our eye on really closely is the labor market. Obviously, we see the labor market is very important for housing because when people have jobs, they tend to make large purchases and purchase homes. And so we've seen pretty anemic job growth throughout much of 2025, and the latest jobs report was pretty disappointing. We can see came in at 92,000 jobs lost. And so what we've been noticing too, throughout 2025, the initial print of what the initial publication number was for job growth was revised downward. And when we look at this, this is the blue line indicates the before the revisions, and then the orange is after revisions. And throughout 2025, about 1 million jobs were revised away. So the initial headline was more bullish, stronger job growth. And then a few weeks later, when they make revisions, generally it's in the next reporting period, the next month, they'll revise the previous couple months down. And we did see 1 million jobs revised away through 2025. We'll see if there is an improvement from what the February print was with the job losses. We'll find that out when the next jobs report comes out. But I thought it's interesting to say, like, even though the initial headlines throughout last year were pretty positive, we did see revisions as we moved through the year. Affordability is obviously still top of mind. You may have seen me show this slide before, but nationally, if we look at the major metros, home prices are up 130% in 13 years. That's a compound growth rate of 7% per year per 13 years. I don't know about you all, but I would take a guaranteed 7% growth rate every year. But that just goes to show you affordability is still top of mind, and it is a big issue that's still plaguing our industry. So even as mortgage rates come down, homes are still unaffordable from a traditional housing cost to income ratio, and we'll look at that in a second. And I thought that this headline was really interesting from the Wall Street Journal in late January. To make homes affordable again, someone has to lose out. So we all like to say we want more affordable housing, but what we really don't want is we don't want deflation. From a manufacturer's perspective, we don't want to lower our list prices. The home builders, they don't want home prices to come down either because they don't want to have year-over-year losses. Distributors, they want to protect their margins. They don't want to see their sales prices go down either. But when you think about all the moving parts, from the suppliers to the manufacturers to the home builders themselves, and we think about that overall affordability equation for the homeowner, it's really a give and take. And so we need to evaluate that as we're thinking about affordability and housing affordability. And I'm not going to touch on it today, but I know the administration has focused on a few areas where they've at least made some announcements about focusing on a few areas for housing affordability and to make home ownership more attainable. We've seen the initial headlines that I think the president has put out over the past couple months, and we're really awaiting policy decisions. We're waiting for that to be codified into law and actually see some concrete examples of how this is going to help. And we haven't seen that to date. But I guess the takeaway here is it's good news that the administration is talking about it, and we're anxious to see what concrete steps will be taken. Looking across the country, we have a under and overpriced market index. And so this is really based on historical trends of where markets are. And you can see there's a lot of red. So a lot of red means that these markets are very overpriced, and very few, kind of fairly priced markets. But generally speaking, most markets are considered very overpriced, looking at the long-term historical trend. We also track we have an affordability index. So this is the housing cost to income ratio. And we think the new norm is around 31.4%. So the housing costs should be about 31.4% of the household income. And we are seeing that come down a little bit. So as rates have come down a little bit, as we haven't seen material prices increase, and we have seen some wage gains, that has come down a little bit. Our projections out to 2029 are for that to remain relatively flat, but still very much above the historical norm, what we call the new norm, the housing cost to income ratio. And really that's weighing on consumer sentiment. We look at consumer sentiment. We look at consumer confidence. We think consumer confidence is more kind of like now, what's going on now, and consumer sentiment seems to be more forward-looking. And you can see that we saw a fall in consumer sentiment throughout 2025. Obviously, a lot of issues weighing on that. Affordability is one of them. The tariff discussions, geopolitical conflicts, all of these things really weighing on consumer sentiment. But we think consumer sentiment has been impeding home ownership, new home purchases, as well as big ticket repair and remodeling. So when we start to see consumer sentiment tick up, we think that's going to be a leading indicator for when we start to see some of the stronger activity in housing. Another thing that we've been looking closely at, and I'm going to spend a few slides going over this, is demographic changes. We think there's going to be some significant demographic changes that's going to impact housing in the coming years. And I'll kind of go through these and what we're thinking about it from a household formation standpoint, as well as a labor market standpoint. We've seen adult population and household growth really converging. The blue line is historical total household growth, and then the orange line is 18 plus population growth. So people that are generally entering the workforce when they turn 18. And we've seen the blue line total household growth and people aging into the workforce converging. And you can see our forecast out to 2034. We're expecting those to fall. We think that housing demand and growth faces headwinds and tailwinds. We do think that there's a housing shortage still. We think that there is an undersupply of housing in the US. But again, as we think about the demographic challenges, we think that that's probably we've been revising our numbers down. We also expect impacts from immigration to play a role too. We think average net immigration to fall about 84% in 2025 to 2028 compared to 2022 to 2024 numbers. Obviously, the 22 to 24 numbers were vastly inflated by huge surge in immigration. So that 84% really no surprise based on immigration policy changes that the administration is doing. And then we see household population growth or population growth in general shifting to ages 40 to 54 and 70 plus. And we actually think that's probably a tailwind for this industry. And I'll go through why we think that here in a second. We do see working age population growth for the first time in a long time, maybe ever, set to decline in 2026. You look at kind of the historical averages of working age population growth, we could see very, very low increases in 2024 and 25, and we expect 2026 to show declines. And if you look at the long-term historical average from 2010 to 2019, their growth average about 1.1 million per year. So this is working age population. Compared to what we're seeing through 2028, we're only expecting that to grow 90% by 90,000. So big delta from 1.1 million to only 90,000. Because of that, we are expecting a slow job growth, really just due to lack of workers. We're seeing slow job growth. Obviously, the number that we saw in February showed job declines. And so we're expecting through 2029 relatively weak job growth just because of lack of workers. And the reason we say lack of workers is because when we look at the unemployment rate remains very low. This is great news for the economy. The blue line is the official unemployment rate. The latest read was 4.3, I think it's 4.4. And then we look at the long term, the U6 is elevated about 8%. But you can see we have really low unemployment, which is great news for the economy. And one reason for that is because labor force participation is at the highest level since the 1990s. I know a lot of people like to say, well, we can't get people to work. It's difficult finding labor because nobody wants to work. But when you look at the labor force participation, we're at the highest level since the 1990s. So this anecdote about nobody wants to work anymore, what we hear, it's tough to get people into the jobs. It's primarily because the labor force participation is pretty strong. So because of the low job growth forecast, we're actually lowering our household growth forecast down slightly to about 1 million new households formed per year, really driven largely by the anemic job growth. So job growth is what we see as a trigger for household formations. When people have jobs, or going on their own, they tend to move out from their parents' house, they age into the workforce, they form their own households. And because of that population shift and what we're seeing in low job growth, we expect lower than usual household formations through 2034. And we do think overall we're expecting slower population growth, number one, due to tighter immigration policy, but also an aging population and relatively low birth rates. So we like to say, we know that somebody that's 40 today was 30 10 years ago and will be 50 in 10 years from now, likely. And so we look at birth rates over a historical time period. And population growth from immigration, that's obviously affected by policy, but population growth from birth rates is not necessarily something that can be turned on pretty quickly. Obviously, it takes, from a birth to aging into the workforce, takes 18 plus years, right? And so we think that what we're seeing, a couple drivers on that, 25 to 28, we think there's going to be an 81% cut in immigration compared to 2024 levels. Again, 2024 was an exceedingly elevated level. And we think policies are going to loosen a little bit in 2029 to 2034, but still you can see overall population growth. From the blue area at the bottom is natural change, so births minus deaths. And then the green is net international migration. You can see we're expecting some tightness there through this administration. I talked about shifts in population, and this kind of looks at where we see population now. So these are living people in the United States right now. And you can see I've highlighted the blue areas. We're expecting strong population growth in ages 70 plus. So lifetime expectancies are increasing. People are staying in their homes longer. So we think this is going to be a tailwind from housing, people aging in place in their homes. But then also in the age groups of really 30 to 54, think about that when you're in that life stage. You're generally, forming households. You're moving into your new first time home. So I think the average first time homeowner is 40 years old. Previously, it might be moving into a move up home, but in that span, you're probably in your first home as well as a move up home. And we like to say we think this is going to drive single family housing demand. Probably a lot of it in the suburbs too, just because of the population growth in these age cohorts. So with that, I'm going to go into new construction and what we're seeing today and what we're kind of expecting for full year 2026. In February, where there's about 496,000 unsold single family homes in various stages of construction. The blue area at the bottom shows unsold finished inventory. So these are new homes that are completed that are sitting there just waiting to be sold. The larger green area are homes under construction, and the purple area at the top are homes that are not started, that have been permitted but not started. And I drew a line across to where we are today with the blue area at the bottom, because we haven't seen these levels of unsold completed inventory since 2009. Many of us on this call and many of us in this industry probably remember what the new home construction market looked like in 2009. I lived through it. It wasn't the rosiest of times. And so what we're seeing is this unsold levels of inventory is really causing the builders, starting probably with mid to late last year, to pull back on housing starts. Here's a quote from Lennar's latest earnings call in December. They've got one coming up, and they say they drive volume with starts, but also at a slower pace. So even the big production builders were slowing their starts until they get some of this unsold inventory off their books. We also do a monthly builder survey. We survey roughly 15 to 20% of all new home sales each month. And our latest reading from February is, you can see the unsold finished inventory per community is well above the seasonal average. So February 2025, unsold finished inventory levels were elevated, and this year kind of more of the same. And so, builders had started these homes thinking the spring selling season last year was going to be strong, and the spring selling season was really a bust, and the homes weren't moving for a number of different reasons: mortgage rates, consumer confidence, consumer uncertainty, expectation of rates to fall. But builders are still sitting on these levels of inventory. And from a regional perspective, we asked them, where are your levels inventory? This is higher year over year. The dark blue line is February of this year. The light blue line is February of last year. And I've highlighted the regions where you can see where builders are saying that they have higher inventories this year than they did last year. Northern California, Southeast, very important housing markets, a lot of volume in those markets. So for those regions to have higher inventory year over year just underscores that effect that it's having. And then even the Northeast and the Midwest, which had traditionally been a little bit stronger, at least through 2025, are also showing a little bit higher inventory levels year over year. So consequently, builders are continuing to pull back starts. This is again from our monthly builder survey, and you can see throughout all of 2025, single family starts were pulled back in the communities, and that trend continued through February of this year. And when we asked the builders to rate what their current conditions are, so with three different sections here, direction of new home prices is the top section. 25% of the builders this past month told us that prices are decreasing. They're having to bring prices down compared to only 23% last year, which was still elevated, by the way. Traffic of prospective buyers, so these are people coming into the communities looking, thinking, kicking the tires, if you will. 25% say low traffic. People are not coming in and really evaluating their options. And then expected sales, only 16% of the builders in our survey expect good sales over the next 6 months. So builders are having a more, I'd say, realistic outlook. And what we've been saying is the spring selling season is really going to be essential for new home construction. We need to get some of these unsold homes off the books so that builders will start new homes. Obviously, that plays into fenestration demand. If we don't have starts, we're not going to have window sales. And so we're really anxiously awaiting the spring selling season, which is really, generally speaking, already started. And that's another reason why I think we were expecting more significant policy decisions and announcements out of the administration. The administration said they were going to make some announcements in Davos that never really materialized. And then the State of the Union didn't get a whole lot of feedback there either. But we think some of these more concrete examples of how affordability is going to be solved, how we're going to really drive new construction is going to be essential for the spring selling season so that we do start to see a rebound in housing starts. When we look at pricing, again, a regional breakdown, we can see the weakest pricing is in Northern California, which had the highest level of unsold inventory from a couple slides back. And really, very, very low pricing growth in the Northeast is relatively flat. Midwest builders say that they're still raising prices by about 2%. But from a national average perspective, when we weight all the new home starts and new home sales, total national average is about 2%. So when we look at everything kind of compared to a lot of different metrics, and I'll go slowly through this one. New February new home price appreciation, so the price increases that builders were reporting, they said nationally prices fell by 1.5%. That was 2% on the previous page. We look at resale home price appreciation. So resale home prices are still appreciating. Obviously, existing home sales have been pretty low, but they were starting to see very slight price increases, but not significantly. We look at single-family rentals. This was our latest survey from December. Single-family rental operators are saying that rents are increasing by about 2%. We also ask about construction costs from our home builders, and in the fourth quarter, they reported total construction costs for materials coming down about a half a percentage point. But what's really telling is the 4.4% jump. This is from we do a land survey each quarter. And in the fourth quarter, land developers told us that their A and B finished lots prices were up 4.4%. C and D locations, which is right next to it, fell slightly. But the big jump is, and we're hearing from home builders, we're hearing this from building materials dealers that we talk to too. Land prices continue to rise, especially in these A and B locations. So that is also a headwind that builders are facing. Another headwind that builders are facing is incentives. So really, since the rate increases of 2022, builders have gotten creative in the incentives that they're offering to really get prospective home buyers off the sidelines. This is a regional breakdown. This is a comparison. February just released a couple weeks ago. This, the dark blue line, and the light blue line is from November. And you can see the incentives. So in Texas, builders reported 10.4% of the total sales price were layered on in the form of incentives. In Florida, it was 9.7%, so roughly 10% still. So these regions that are showing weaker new home sales growth, builders are having to layer in more incentives to really get people off the sidelines and entice home buyers to purchase a new home. And we ask, what are the types of incentives that you're doing? Rate buydowns are really in the top three most common. We're seeing price cuts on inventory homes, help with closing costs, but then rate locks, buydowns, or below mortgage rate or originations. So you can see the various methods, but rate buydowns are really continue to be the top most common incentive across all regions. Looking ahead to our forecast, because of the elevated levels of unsold inventory, we're expecting for 2026 to see a 2% decline year over year in single family starts. We do expect an increase in 27, 28, and 29 as we do get some more clarity on some of these policy decisions, as mortgage rates might improve a little bit as some of these incentives from the administration may take form. So, but we're expecting, because of the inventory, that we still see on the books a 2% decline in single family sales. On the multifamily front, this is something that has higher propensity to change. We're expecting about a 9% decline in multifamily starts for 2026 before rising through 2029. One of the reasons that we're anticipating multifamily starts to be stronger, even though it's a much smaller base, is just due to that affordability piece. We don't expect to see significant relief in single family housing affordability. That will tend to push more towards rental, which then also tends to push more towards multifamily. So that's the primary driver why we think multifamily growth is going to be stronger from a percentage basis. On the R&R front, we'll talk about a few topics here, and then we'll move into the window to market survey. No surprise, we've talked about this quite a bit, but building material costs really rose by about 40% since 2019. We've talked about this over the past several years. This is material inflation. But I think what a different spin that we've been showing recently is the real impact that's showing. So in your average remodeling project in 2019, this is something that we've got from the BEA and some analysis that we've done. The average cost of a remodeling project in 2019 was $22,000. The current price is $31,000. So it's a pretty significant bump in cost, primarily due to material inflation, but also labor inflation. Again, a tight labor market leads to higher labor costs. So there's also labor inflation in there. But the average project on a discretionary project has gone up pretty significantly. If you layer in financing on top of that, that total project costs are up 45%. So again, that 22,002 for 2019 has gone up to 31,000. And then if you layer in financing costs, and this is assuming a 30% finance with a HELOC loan with a 10-year payoff horizon, based on current HELOC rates, that adds even more. So if you think about that, if you're financing the cost for a discretionary project, that average sticker price has gone up even more significantly. This is from our latest quarterly remodeler survey. We survey roughly 500 professional remodelers, from full service remodelers to design build firms. And so we say, what is the biggest barrier to growing your business? What's really holding back growth over the next 6 months? And for the past several years, it's been consumer uncertainty. So we can see the dark blue line on top this time is from the fourth quarter, what they told us a couple weeks ago, their fourth quarter results. Consumer uncertainty is higher. Tariffs is high this year. We didn't ask that last year because fourth quarter of 2024, tariffs weren't a thing yet. Building materials costs, and then skilled labor shortages as well. But really, it's that consumer uncertainty. So think back about that slide that I showed previously about consumer sentiment. That is the big factor. So that's what we're looking at really closely. When we start to see an improvement in consumer sentiment, we think that's where we may see some unlocking of some of the big ticket remodeling projects. Another thing, we've showed this before, is the mortgage rate lock-in effect. So all outstanding mortgages, about 52 million outstanding mortgages in the US, 20% are still below 3%, 52% are still below 4%, and then a total of 69% are locked in at mortgage rates below 5%. I want to call your attention to a couple things on this. Number one, you can see some movement. If you think about the total mortgage, you can see some movement in the orange and the green and the yellow areas at the top and the purple at the top too, which I'll touch on in a second. But you're not seeing a whole lot of flattening. So people that have 3 in the blue area below, the people that have mortgages below 3%, they're not taking on new mortgages. They're not moving. But what is interesting is I don't know if you can see it on the screen, but I've highlighted the 21% purple at the top. So 21% is mortgage rates above 6%. There is a higher percentage of mortgage rates above 6% than there are below 3%. So obviously, homes have transacted over the past several years. There have been new mortgage originations, but we're keeping our eye on that because that will lead to, as rates do tick lower, if we do get below that psychological barrier of 6% for an extended period of time, we think that's probably going to unlock some refinancing, which will then in turn unlock some remodeling. We've touched on this before too, but home equity levels are near all-time highs, both in total and per household. The blue shaded area at the bottom is the real homeowner equity in trillions of dollars on the right side. So roughly 35 trillion of homeowner equity in outstanding homes right now. And then the real equity per home, you can see that's that blue chart. That's also ticking very high. So homeowners are still sitting on these record levels of equity in their homes. But despite all that, they're not tapping it. They're not tapping it. Homeowners are not tapping their HELOC, and we can see a very historically low percentage, only about 1.2% of that. At its peak was around, coming out of the GFC, about 8% of total home equity was borrowed through HELOCs. Obviously, that may have gone into other things at the time, but we've seen that number come down, but it's remained relatively flat. So even as we had strong price appreciation in existing homes beginning in 2022, we haven't seen a lot of equity being tapped. One of the reasons is obviously the number of outstanding mortgages at that below 3%, below 4%, below 5% range. But that those levels, even as rates have ticked higher, we're not seeing a significant increase. When we look at HELOC rates, they have retreated over the past 18 months, but still, if looking at the long-term historical average, we can see that it's still above the historical average. The Fed has signaled further rate cuts if short-term rates fall with Fed fund rate cuts. We think that's going to drive down HELOC rates. And so we think in the second half of 2025, we saw a 0.6 percentage point decline, expecting around roughly 3 percentage points in January of this year. And for the rest of 2026, we think, just taking the Fed at their word, they're penciling in 2 more rate cuts this year. That'll drive another 0.5 percentage point. So really, since July of 2025, we think that there's going to be about a 1.4 percentage point cut in interest rates by the end of this year. And that would put the HELOC interest rate at about 7.2%, which is getting close to the long-term historical average. That could then drive unlocking of that and spur some big ticket home improvement projects. Another driver is existing home sales. So there is existing home sales do have an impact on remodeling activity. Obviously, there's activity that would go in before the sale, and then once homeowners move into the homes, there is further remodeling activity. We do expect a modest growth in existing home sales in 2026, and then through 2029, slow uptick. Again, that lock-in effect of low mortgage rates that will start to thaw somewhat, but really not to the levels that we saw previously. Certainly not to levels of long-term historical average. So that will be a tailwind for the remodeling industry, but again, not to levels that we've seen throughout history. We did some modeling, and this shows the blue line is the homeowner R&R project, and it's closely correlated with existing home sales. Existing home sales typically will have about a 2-quarter lead for big ticket remodeling projects. And so when we start to see a thawing of existing home sales and existing home sales transact more, then we do expect to see an uptick in big ticket remodeling projects as well. Another topic we've talked about quite a bit, but maybe not visualized this way too, is the U.S. housing stock continues to age. So we think about the homes that were started in the 90s, in the early 2000s, the wave that we had in the early 2000s pre-GFC, and then the existing housing stock now. We can see the median age. In 1985, the median age was 23 years. In 2005, it was 32 years. And in last year, the median age of existing homes on the market, all homes in the market, is 44 years. So obviously, as homes age, they become more susceptible to needing repairs. Obviously, window repairs is a big driver of that too. But the age of housing stock is creeping up. And another thing we've been looking at too, there's been a little bit of talk around it. We've started to see some manufacturers actually talk, and some dealers talking about marketing to this. This tax season, tax returns are expected to be significantly larger than usual. And the reason for this is the One Big Beautiful Bill Act. For those of you that may not be aware, the One Big Beautiful Bill Act had significant tax cuts really across most income classes. However, the payroll deduction tables were not adjusted until 2026. So people that worked throughout 2025, their payroll deductions kind of stayed the same as they were in 2024. And that was really by design because they wanted to reset the tables in 2026 for 2025. So when people start filing their taxes this year for their 2025 income, expecting to see a larger tax refund. This could be a tailwind for remodeling. I kind of put the snarky image here of like homeowners evaluating to take a vacation, do a remodeling project. But we do think that that will impact remodeling to some extent, as 63% of all remodeling projects are funded by cash. So we think that that will be a tailwind. So now we're going to move into what we saw from the latest Window+Door market survey. Many of you who participate in this each quarter on this call, and thank you very much for that. We would love to have more participation. I've got a QR code at the end to download these slides and get in touch with me. So we would love to get everybody's feedback. And the more that we have in this survey, the better it's going to be, and the more robust the results are going to be. So thank you for those that do participate. And if you'd like to, we'll have a shameless plug at the end to get you to do that. So a little bit of background. This is an exclusive partnership between Window+Door Magazine, the National Glass Association, and our firm, John Burns Research and Consulting. It is a quarterly survey of residential manufacturers, glass shops, glaziers, and installers. We do things like we measure volumes. So this is shipments as well as revenue, lead times, backlogs, supply chain issues, and then forward-looking guidance. And we like to say this is a qualitative data set. So what are people telling us in actual numbers from shipments to backlogs to revenue numbers, as well as qualitative industry commentary. So things that may not be reflective of numbers, but it is qualitative information that really helps us inform our thesis and what we're really gauging the sentiment of the industry. So throughout 2025, companies did report volume declines through most of the year. You can see this on a quarter-by-quarter basis. We asked 2 questions related to shipments and installations. Are they growing, flat, or declining? And you can see although a larger share said that total shipments were growing, shipments or installation were growing, throughout 2025, we saw total shipments decline. So we kind of lump everything together and weight them. We did see shipments decline. And that obviously had an impact on revenue then too. We like to look at backlogs because backlogs is a leading indicator for future demand. If backlogs are growing, that means that sales are probably going to be growing, and we should expect to see higher shipment and higher revenue numbers. And we can see 42% said in the fourth quarter that backlogs did decrease. No surprise, we saw more say that backlogs decreased as we move through 2025 than increase. So that really weighed on total full year shipments and total full year revenues. And then looking forward to the first quarter of this year, which I have a slide on in a second, decreasing backlogs really gives a little bit of a less rosier view of the near-term outlook. We've been asking about lead times across input materials. So we asked the OEMs, thinking about all the things that go into all your windows, from float glass to hardware, to framing, et cetera, aluminum for cladding or for the spacers, trim molding that goes with them too. Are you seeing extended lead times? We did see a bump in the third quarter. So as some of the trade policy got firmed up throughout 2025, we started to see some bottlenecks, particularly around hardware and components, and then also from aluminum. That seems to be resolved. We heard some qualitative commentary in the third quarter of manufacturers saying, yeah, we're looking at alternative sourcing methods. We're trying to nearshore or onshore or domestically produce or source domestically. So the good news is 81% said we don't have any extended lead times. We're getting everything that we need. Just a very small percentage saying aluminum, hardware, and components, and maybe some trim and molding, which is a lot of hardwoods coming from overseas. Slight extended lead times there. But the good news is at least the supply chains seem to be normalized. We've had a couple of things happen geopolitically, to say the least, since that time. So we'll be keeping our eye out on this for the first quarter results, which we'll be surveying in April and May. But for right now, in the fourth quarter, manufacturers said most of the things that they were reliant on for their supply chain were able to be sourced okay. But when we look at material costs, we ask the manufacturers, are your material costs going up, down, flattish, and then direct labor costs? The blue is the average year-over-year material costs, and the orange is direct labor costs. And we could see really progressing at the end of 2024, but more significantly as we move through 2025. So as the tariff picture got crystallized, as we started to see some of them implemented, we could see stronger than usual growth. Looking back to the results on the left side of that chart, direct labor costs were outpacing material costs, and we've seen the reverse of that. So as the labor market has softened, we've seen, I would say, a stabilization of direct labor costs, whereas material costs continue to rise. And here's one of the qualitative comments that I mentioned from our survey that I've inserted here. This is a direct quote, and it just said, "Tariffs and political uncertainty are killing the business. We need to return to free trade, predictable business environment where we can properly forecast demand and labor needs." And I'm sure this quote probably speaks to all of you who are in the manufacturing space, but then also in the installation space where you're procuring materials from elsewhere. This really just kind of accentuates that point around tariffs and material costs going up. So because of the disappointing results through 2025, we're looking at sequential shipments. So this is what manufacturers and installers expect in the first quarter of 2026, of which we're almost through now, versus the fourth quarter of 2025. Nobody said they're expecting higher shipments, which is a surprise. That's the first time that we've seen that in the survey history, where literally no one in the survey says, "Yeah, we're expecting to ship more in the first quarter than we did in the fourth quarter." There's obviously some seasonality in there, but still the first quarter you're moving into spring. That's typically when things start to thaw, when demand starts to pick back up. And 58% of the respondents said they're expecting fewer shipments in this quarter compared to last quarter. And then total shipments are expected to fall by over 5%. So the chart on the right really shows expectations, not reality. So you can see expectations were pretty muted. Beginning in the first quarter, thinking, going to shipped 5.6% more than the fourth quarter of 2024. And so the first quarter is generally the more optimistic quarter, and I kind of included that just to highlight the difference, the stark distance. So this really screams at kind of the pessimism that the industry is seeing in the first quarter. We do expect a turnaround here, and so as we move through this year, we've started to see this in our expectations when I talk to lumber and building materials dealers each month. I mentioned we talk to our home builders each month, and just the sentiment that I was able to capture when we went to IBS too. I think it's generally just a kind of a more realistic sentiment. I think everybody entered 2025 thinking it was going to be stronger on the new construction side as well as repair and remodeling, and that just never really materialized last year. So we think that everybody's just kind of taking a more realistic / wait and see, and we're going to see how 2026 transpires, because 2025 did not transpire as people expected it to. When we think about revenue increases quarter over quarter. Manufacturers and installers are saying we expect revenue declines. Again, this is first quarter of 2026 versus the fourth quarter. So fewer shipments, but also lower revenue. And again, you can see we did see 25% of the respondents said they are expecting a little bit higher revenue, probably primarily due to price increases, and not necessarily higher shipments, as total shipments are expected to fall. But still, if we kind of lump everything together and average it together, total revenues are expected to fall quarter over quarter by about 4.4%. We ask about total shipments for 2026. This again is a comparison of what they told us in 2025. So this is the same reading from a year ago. Again, expectations, shipments were going to grow by 5.6% last year, and they didn't. Total shipments fell throughout all of 2025. And so kind of to the point I was making about more realistic expectations, everybody's saying we think for full year 2026, shipments are only going to grow by about 3%, a little over 3%. So, as we move through this year, as things start to thaw, hopefully, and we get a more optimistic view on housing, hopefully, we'll be watching this because we do ask this each quarter to see how expectations do change moving through the year. When we think about revenues, so we showed previous slide, shipments to grow by 3.3%. Expectations for revenue is to grow by 5.6%. So the good news is over 2/3 of the respondents say we do expect revenue to grow. But again, looking back to a year ago, the expectations were that total revenues would grow by just shy of 8%, when in reality, manufacturers and installers, everybody kind of lumped in together, said revenues only grew by 1.8%. So because of missed expectations in 2025, those expectations have kind of been dialed back a little bit for 2026. So again, as we move through this year, it's going to be really interesting to see how these developments change. Hopefully, we see some improvement, but that's why it's really important because we think this is a really good gauge on what we're seeing in the overall industry. So with that, just a couple of takeaways. We do think some near-term headwinds remain. This says remodeling, but this is really for new construction and for R&R. Near-term headwinds, they do change. They remain. Macroeconomic challenges are really driving that consumer uncertainty. Pricing for materials and labor is really driving the affordability issue. We're not expecting a ton of relief on the affordability piece. And then unsold inventory continues to weaken on new housing starts. Longer term, we do have a more positive outlook. We do expect single-family and multifamily starts to rise beginning next year. We expect to see an improvement as we move through 2026. And then we think easing financing costs, mortgage rate relief, tax savings that should increase some spending in housing. And then we think that mortgage rate lock-in effect is still going to bias more towards remodeling, especially for larger ticket discretionary remodeling. So with that, here is a QR code. I'm going to leave this on here for a few seconds. If you'd like to download the slides, you can scan this code on your screen. There's a brief form you can fill out, and then our team will send the slides over to you. You've got my contact info here too. I'll leave this on for a few minutes, maybe while we move into some Q&A, and then I'll move to the next slide, which as a wrap up, but I'll leave this up for a couple minutes. So with that, thank you very much and look forward to your questions.
Yeah, thanks, Chris. It was just terrific. Really, really thorough. And please do, if you're listening, post your questions in the Q&A. We've got a couple in there that I'll go through. But, Chris, just to lead us off, I think we all kind of fancy ourselves to be armchair economists. There's just so much out there every day in the news about, what's happening on the macroeconomic level and how that might impact various industries. What are some of the biggest misconceptions when you look at when you're chatting with an armchair economist? What are some of the biggest misconceptions that you're hearing from people right now?
So that's a great point. I think one topic that we hear a lot, and I hope I illustrated this point, kind of a counter view, is that the job market's terrible. The labor market's really weak. If you look at job growth, that's true. But then if you look at if you look at the employment picture, labor force participation, then it turns into not so true. So that's why we can have, headline print of, wow, significant job losses in February, yet the unemployment rate remains relatively low. So that's one piece of it. And so, that tightness in workforce, that could be that should be a tailwind for wage growth too. That in turn will help with the affordability picture too. So if we get some wage growth and the housing cost to income ratio improves, that will unlock a whole lot of things for housing. So that's one. It seems like you can't even open your phone or anything nowadays without hearing about the K-shaped economy. I think I get at least 2 or 3 notifications a day through Apple News or whatever it is around the K-shaped economy. What we're seeing is the luxury consumer, the higher end consumer continues to spend. So we're seeing, retail sales not super strong, but still growing in a lot of areas too. And so it's important to look at, job growth, which sectors are growing, and then which sectors are not. A lot of it's education and healthcare that's growing. Government jobs are declining, but the higher end consumer continues to spend. We're seeing that. We did see a little bit of a softening, and so the question is like, well, how long is this going to continue? And my answer is hopefully forever, but those are the things that I'm hearing right now. I think this misconception around the labor market being exceedingly weak. Obviously, headlines around AI is going to replace so much of the workforce. Maybe. I think it's too early to tell. I mean, I'm old enough to remember that when they said the same thing about the internet, and actually we saw job gains with the internet too. So that's a great question, though.
Yeah, thanks, Chris. So one specific question that we received. So on your chart that was displaying unsold built inventory, Did that show empty units? Did that include multifamily or just single family?
That was single family.
Okay, great. Okay. We also had a question come in about, in tougher market environments, how do you see the new energy codes and possible future impacts in new areas? Do you think that the more stringent energy codes will slow down or be decoupled? And how do you see the market impact with energy codes, for example, Title 24 in California?
So energy codes are, like a flip a coin, and it could go either way. That's kind of a flippant answer. We did have a decision, I think it was last week, around. I was talking to a colleague about this morning. We spent a lot of brain energy last year thinking about the HUD mandates to get HUD loans, IECC 2021. That was a requirement, and there was a lot of talk in this industry on Energy Star 7.0. And so recent developments like the HUD requirement for IECC 2021, that was thrown out, that was dismissed. So that seemed to be off the table. Energy Star was going to be defunded initially. I think it was defunded. Now in the reconciliation, I believe it's funded through 2026, but then longer term I think longer term fate of Energy Star, at least near term in the next couple of years, is probably going to be going away. Regardless, you do have local municipalities and you have states that are still affecting energy code. I mean, energy code it is a patchwork. So federal mandates are probably mostly off the table right now. I think there's not going to be a significant push for federal energy code requirements, especially as we think about affordability and the cost that goes into that. But you're still going to have pockets like California, like Colorado, New York. Those are the states where they're still pushing that. Um, Makes it difficult for manufacturers, and it makes it difficult for installers to really get behind them. Do I think that there's going to be federal government superseding state requirements? I don't think that's possible, and I don't think that's going to be an issue either. But I would say it depends on where you're doing business and where you think your pockets are. But I think it's gonna stay more of a local issue and not a federal issue right now.
Hmm. So the next question is about labor. Do we have any hope for labor? I assume it's referencing kind of the labor shortage, considering the impact of immigration enforcement and immigration to and its relation to construction jobs.
Yeah, we're not seeing a big thawing there, honestly. It has been more disruptive at IBS, talking to a lot of people, and then also some of the conferences I've attended recently. Beginning last year, it kind of started off as like, yeah, you'd hear it in pockets. And I was with a group of builders last week from across the country, and they all pretty much said, doesn't matter the market you're in, it is having an impact. We asked building materials dealers last month, from what they're hearing from their builder and contractor customers, as well as what they're seeing in their own yards. Is it easier to find and retain labor than this time last year, or harder, or is it about the same? And roughly 40% said it was about the same, but a higher percentage said it's actually become more difficult to find labor, not just skilled. I'm just talking about general labor. Skilled labor is a shortage. I mean, that's regardless of immigration skill. We have a skilled labor shortage in the U.S. So not seeing a ton of thawing in the labor market right now. And like I said, I'm hearing that from remodeling contractors, hearing it from builders, from dealers. So it is having an impact. Some markets are more disruptive based on what happens to be going on there at any given time, but not seeing a ton of relief, which is why, again, look at our projections for job growth, and it makes it tough to see job growth with the labor force participation that we have right now. So the good news is, maybe some of I'm kind of joking, but the white collar jobs that are going to be eliminated with AI, learn how to use a hammer. I'm kind of joking on that, but yeah, that it's tight.
Yeah, thanks. So we've got just a couple minutes left, so I'll toss one up for you. Maybe you could do a quick fire on this one. What has surprised you in the last 6 months, 12 months?
I think the thing that has surprised me is, and I touched on this earlier, the resiliency of the higher end consumer. So, we've obviously had a lot of volatility and geopolitical issues and stock market volatility, which, overall wealth a lot of it is driven by stock market performance, which the market's been up until very recently. But the resiliency there and like how long can that continue? That's like I said, I hope for a long time, forever. That's really shown. But then also you think about what we've been through from interest rates and just how the builders have been able to adapt. And so what's telling is when I talk to dealers that are like frontline, they're dealing with the homeowners, they're dealing with the builders, the contractors, and what I hear is it's not great, it's not terrible. So it's
Mhm.
it's kind of just been kind of ho-humming along. And so I
Mhm.
think that really is a testimony to the industry and also the housing demand that despite all of the headwinds that we faced, that we're still seeing low single digit declines or even increases in certain areas. But
Sure.
that's really kind of what's surprising me.
So we just got one final question in, and I do want to give it just some time, but maybe it can be another quick fire, but I'll read it verbatim. So the market expects inflation numbers to go up in the next reading, given the war in the Middle East and gas prices off the charts. How do you see that impacting Fed's rate decisions and the growing concern around stagflation? Does that influence your forecast on the pace of housing market recovery?
It hasn't right now. We're certainly thinking about that and we're monitoring that. Another thing I think you could maybe chalk it up as surprise is you look at the tariff impact that we've had and the headwinds from that wasn't really reflected in the inflation numbers. So that's, the cynic in me kind of says like, let's let this play out. On paper, I think that we probably should have some inflation, higher inflation readings. We'll see come May, we've got a new Fed chair. We'll see what that looks like. But right now we're kind of our expectations are as they were. But again, this is unveiling in real time too.
Yeah. Well, great. Thanks, Chris, for staying on an extra minute. On the screen here, you'll see our upcoming webinar from the NGA in April. And thank you all so much for joining. Chris, thank you again.
Thank you. My pleasure.